If it is pre-tax, chances are you could be looking at $2, $3, $4 million in these retirement accounts in their entirety. When it comes to the RMD, when it comes to you taking money out and taking money out if you need that money or not during retirement, you're going to have to pay tax. And of course, you're going to pay tax on the much larger balance that you're going to have from really that compounding that we're seeing when you start looking again at the biggest nest egg that you can think. When you start taking money out of there, it can create a very, very big tax burden for retirees, meaning that it could actually put you in a higher tax bracket because of the contributions and the growth factor. You could actually be earning more or paying more in taxes during retirement. And again, it's really very specific to an individual situation or a standard. If you're an individual that makes 50,000, let's say, you make 50,000 a year, you start putting away 15 or 20% in the course of 40, 45 years, you can far eclipse through RMDs what you're making at the 50K a year. And it's kind of crazy to think. Now, when it comes to the Roth, even thinking of that same scenario where if you're paying or if you're making that $50,000 a year and you're putting it into a Roth paying your taxes right now, by the time you get to that big balance at the end and ready for retirement, that money can grow and is growing tax-free. Compounding is tax-free. Withdrawals are coming out of tax-free. Now, of course, there is going to be some money again that you're going to have to utilize for retirement, but it makes sense when you start getting a big tax-free nest egg. Like Dave Ramsey says, always take the eggs, don't kill the goose. If you're looking at $2, $3, $4 million in that account, you can live off the interest 100% tax-free as long as you don't exceed the capital gains tax that is coming out of there, which again, depending on if you have brokerage accounts, Roth accounts, of course, are entirely tax-free, but you can make up some of the income. You can do a lot of very crafty things when you think about it. Now, the big disadvantage with really the Roth conversion, rolling over funds from the 401k to the Roth, is once the Roth account invested earnings qualified withdrawals are both tax-free. That, of course, is one of the big advantages, but Roth accounts are not subject to RMDs, which is better for retirement. You can control the funds and really use them where you need to. However, the big thing is the upfront tax bill.